thank you so much. This is the last episode of Conversation for this year. Christmas is nearby, and today we have Manish from ICICI Mutual Fund, a local Calcutta guy. I came to know today itself only, but great. So, we Calcuttans have a lot of love for local people. So today we will be talking to someone who was born and brought up in Calcutta?
Yes.
And graduated to head ICICI Mutual Fund and possibly manages most of our dead money out there. So I'll start this conversation, Manish, with you by asking you that we have seen a big surge in bond yields in, I would say, last 1 year's time. In current scenario, how should our investor design their portfolios on debt side, keeping this high interest rate in mind?
Right. So, thank you for asking me this question. And the asset class which we're talking about, fixed income, it's a cyclical asset class where interest rates keep on moving up and going down. So there'll be periods of time where interest rates will move up, there'll be periods of time when interest rates will remain high at a pause, and there'll be periods of time when interest rates move down. I think we have moved to a point where fixed income as interest rates will remain at a pause for a long period of time. Now therefore your strategies on fixed income should be in line with this thought process. I think RBI will hike another 25 basis points in the next monetary policy and possibly will take a pause. Even if you look at the external world, Fed is tapering off its policy hikes, and the expectation is that Fed will hike in the next two policies and also take a pause over there. So therefore, I think most of the rate hikes are in India are done, and therefore, with that thought process, you should invest, on the fixed income side. Now, one may think that if RBI has paused interest rates, I should invest in a very long duration strategy. Now, the challenge with that is that in a long duration strategy, you will make money only when there is a possibility of a rate cut. What my thought process is that at this point of time, we are going to see a pause, not a rate cut cycle. So therefore, you should invest in portfolios which don't have aggressive duration, but you should look at YTM of the funds. After a long period of time, I think the concentration of YTM as a strategy should be what I would suggest to investors.
Manish, ICICI Mutual Fund has been in a house which has consistently tried to communicate asset allocation to all our investors. Now today, possibly at 750 kind of a yields, do you think we should start rebalancing our equity portfolios and the kind of a gains that we have already made there and move that money to target maturities or other debt avenues which are available in the market?
So you're right. When we practice asset allocation, we understand that different asset classes will differently generate returns in different environments. Not that I'm negative on economy. I don't think the corporates will start to generate earnings which are lower. But the challenge with equity is that valuations are expensive right now. So when we do an asset allocation model, we compare debt valuations against equity valuations. And what we observe over there is that debt is a much cheaper asset class right now against equity, which effectively means that you have to change your portfolio allocation more towards debt than equity. The better way to do it is, I think, if you have an asset allocator fund which does it for you. We run a number of asset allocation funds like the Balance Advantage Fund or the Asset Allocator Fund, the Multi-Asset Fund. We think the theme for 2003 for an investor who wants to manage equity portfolios is to move to these asset allocation funds. But from a specific asset class perspective, we think it's the year of debt.
Okay. And Manish, considerably if we see India as an investment place have possibly remained decoupled from major global economies or markets that we have seen right now. I want to understand from you, how long can we remain decoupled, knowing the fact that US is almost entering into a recession now?
So I think the cycles of US and India have not been aligned for a long period of time. I remember in 2011-12 where Indian growth was very good, Indian rates were very high, US had a 0% interest rate, right? And US was very slow at that point of time. And then after 2014, US did very well in terms of growth, but our growth was slow in that period between 2014 and 2020. So it's not that the two countries are too coupled in terms of overall outlook. The US growth does have impact on as far as exports are concerned, for most of the countries. But thankfully, India is not an economy which is based on exports as such. Our domestic demand is much bigger than the export part of it. So yes, export demand can come down if US goes into a recession, but I see the domestic demand at this point of time quite robust. After a long period of time, I've seen that the real estate cycle is turning. I think 2012-13 was a time when it peaked, and the last 6-7 years have been very bad for the real estate cycle. It's that part of the economy which supports economic growth in a very big way. So if we can continue to expand our domestic demand and support it through our supply chain, I think we can remain decoupled from the US cycle. The other thing is, I think RBI has beautifully not allowed the tightness of the US policy rates to seep into India.
Yes.
So while the policy rates in US may go to 5%, I think we'll stop at 6.5%. So we're not tightening our economy in terms of interest rates in line with US. So therefore, if US goes into a recession, which they would, I think, if not a recession, they would go through a slower phase of growth. I think the policy rates in India are not in a phase or in a manner which will slow down the domestic demand. So my view is that I think the overall outlook for India will be different from US from that perspective.
That's, I would say, very much acceptable as far as the Indian investor is concerned, very soothing, I should say. And Manish, I also have one more observation. So we operate in a space where our investors are mostly high net worth individuals or family offices. And the big shift or a trend that I am seeing is that corporate bonds have become very attractive space for them, and our investors have actually started allocating money other than mutual funds into some of the corporate bonds also. So how do you see that? Is it a wise strategy at the first place? And second, what kind of a risk our investors should also keep in mind when they are directly going ahead and purchasing some of these corporate bonds and perpetual bonds?
So I think from a macro perspective, I think we are in a very healthy credit cycle right now. So from that perspective, most of the corporate balance sheets are deleveraged right now. So I am more positive on credit as an asset class. But when it comes to micro, is where you need that research to understand which credit are you handling. And I think credit is more research oriented than macro, right? So therefore, it is very important to have a framework of research, and you just can't look at credit ratings. We've seen in the past that simply looking at credit ratings is not a sufficient condition for investing in portfolios. You have to manage credit risk, you have to manage portfolio concentration, which I think if there's a framework with which an investor works with, it should work for him. But that framework is not simple, because we've seen that if I'm a institutional portfolio manager, I work with certain caveats which are cast in stone, and I can't change that. But when I see myself as an individual investor, my risk levels are very different. So I think that discipline is something, if somebody as an individual investor can work with, it works for him. But that discipline needs to be there, which I think I would say for me as a portfolio manager for ICICI Prudential, that risk framework is what I work with. And I think that that's very important. We've seen different periods of time where credit has worked differently. But because of the risk management framework, the kind of assets we've chosen to be in, the kind of concentrations, liquidity we've maintained, I think all of that is important. So while at this point of time, if you're buying a 5-year bond, at this point of time the credit cycle is positive. For unfortunate reasons, if something goes wrong in the next 3 to 5 years, if you not manage your risk well, I think there can be accidents. So I think you have to analyze each and every credit individually, understand the risk involved in that, and then invest in a particular product. The difference between debt and equity is equity, normally people think that if you're choosing individual stocks, and in a portfolio of 10, if two or three stocks do very well and the rest of the portfolio does not do well, even then you make money. As far as debt is concerned, if you have 10 stocks and even if one stock does not do well, it takes out the return of the entire portfolio. So the risk and return is very different between debt and equity, and therefore you have to be mindful while you construct portfolios in debt.
Right. And Manish, one more thing where I wanted to bring your attention to is that you see, with rising interest rate scenario, credit growth in this country is actually going up, but deposit growth is not happening. I mean, why is it so, and what could be the reasons behind it?
So one of the reasons why we've seen low deposit growth was, at least for the last year, the banks had enough liquidity on their balance sheets. The liquidity in the system which RBI provides in terms of primary liquidity, that was large enough. We started last year with a base of 9 to 10 lakhs of durable liquidity, and banks initially dipped into that for creating the loan growth. Now we have come to a situation where most of this durable liquidity has been absorbed in the system, and we are left with only small amounts of primary liquidity. So now if banks have to create loan portfolios, they need to shore up deposits. What you've seen is now there's pressure on the deposit rates and banks are increasing retail deposit rates. So I think in this cycle, the credit growth will remain strong and banks will have to sufficiently increase deposit rates to make sure that they have enough sufficient funds to lend, which effectively means that the NIMs of the banking system, which was very high over the last 1 or 2 years, those NIMs will start to compress, because while the lending part will remain competitive, banks will compete with each other on the loan side, the deposit side will also remain competitive for the banking system, where each individual bank will have to raise deposit rates to get a bigger market share of the deposit market. So I think that margin shift will happen in the banking system, and if the deposit rates move up, I think banks will be able to shore up deposits.
Right. So would it be correct at my level to evaluate that maybe in a year or two time, fixed deposit rates could substantially go up, and in comparison to our target maturity products and the kind of yields that we have in our funds?
So I would say both go in line with each other. If you look at the last year, a 1 year CD used to trade at close to 4.5%.
Yes.
And the FD rates were also in the 3.5-4% band. The wholesale market or the capital market, they move much faster than the retail market of deposits. So we've seen that the 1 year CDs now come up to a level of 7.6, 7.7, and the retail deposit rates are catching up. So retail, I think yesterday or day before, SBI increased its retail deposit rate from 625 to 675 on certain period of deposits. I think it was followed by HDFC Bank, ICICI Bank, Axis Bank, who also raised deposits by 50 basis points to 7%. So I think the retail market has to shift to where the wholesale market is. So effectively, they kind of converge after a period of time, but it is the capital market which moves first, which is why now we're seeing that the retail deposit rates are also moving up.
Right. Manish, I can't end this conversation without asking you, if you look around in last 1 year, the way in which currencies have moved, it is like stocks. Euro going up 10% in a month is unheard in my 15 years of career in this market. So if you could broadly touch upon these currencies and global markets for our investor, it would be of great help.
I think we've seen a big change in the global marketplace. Last 40 years, if you look at what has happened on the fixed income space, yields have only come down. We've seen a period where inflation has been low and yields have only glided down. So there was a thought process that yields can never go up, and with that thought process, there was so much of investment which happened with the thought that your bond yields will always remain low. We've seen European bond yields at negative for a long period of time. We've seen even the US bond yields sub 2%, sub 1% for a long period of time. So when you have that framework, the way in which asset allocation is done is very different. People tend to invest more in risky asset because they don't get yields on the bond side, right? All of that I think has changed. That trend of lower interest rate, I think that has reversed, and this is not reversed for a short period of time. That is reversed on a more structural basis. I don't know whether in the next 5 years the Fed will do QE or not. So we're moving from a place where the central banking was more about the zero interest rate, the QEs, now to interest rates which are more acceptably high. And when that is the framework, in that framework, when the change happens suddenly because people are not prepared for it. So in that change, you would see that there's a big shift which happens in the yield markets. There's a big shift which happens in the currency market because currency markets are also kind of linked to the rates market. And which is why this year we've seen these shifts happening where bond yields in US, nobody would have imagined that they would see, the 2-year bond yields closer to 5% in US. Nobody would have imagined that yen, Japanese yen, which was supposed to be a stable currency, would move from 110 to 140. So this big shift, whenever this big shift happens, people are unprepared, and because people are unprepared, the moves are so obtuse. But now I think the framework with which people will work globally as well, the asset allocation models will change. People will allocate more money to debt because debt is a more acceptable asset class at the yields at which it's trading, and which is why some of the other asset classes where there was a compulsive investment, all of that will change as we move ahead.
Right, Manish. Let's end this conversation on this note. What kind of levels you will keep in mind in 2023 as far as 10-year GSEC is concerned?
My broad framework is that in a mid-cycle, the 10-year trades between 7 and 8%. So I would think that largely we will be in that range in this year.
Correct. All right. Thank you so much, Manish, for spending your time with us, and it was really great talking to you. Thank you so much.
Thank you.